Barings BDC adding to this 12.9%, yielding BDC on the dip. This article was written by ADS Analytics. Summary: we take a look at the Q4 numbers from the Barings BDC. Barings BDC trades at a 15% discount to book, offers a 12.9% total dividend yield, and has a stable NAV over the last few years. Net investment income fell slightly over the quarter. Base dividend coverage remains strong at 108%. Non-accruals are very low. However, there was a net realized loss during the quarter. BBDC's valuation differential versus the sector remains wider than its performance differential, making the stock attractive. We are ADS Analytics, a team of former researchers and trading at several global investment banks. We run the investing group Systematic Income, where we scour all market sectors in our search for attractive high-yield opportunities. In this article, we highlight the recent quarterly results from the Barings BDC, BBDC. BBDC trades at a 15% discount to book and a 12.9% total dividend yield, above the sector median, with an 11.6% net investment income yield, in line with the sector median. The company has a relatively high allocation to equity securities. It is overweight in tech, healthcare, and finance sectors, fairly typical of the sector. Quarter update: net investment income fell only slightly from the previous quarter, outperforming the broader sector, primarily due to a non-recurring fee item. It is around 11% lower from a year ago level, largely as a result of lower base rates. The company announced the same base dividend of 26 cents. It also announced a series of quarterly special dividends of 5 THB each for the first 3 quarters of 2025. The total dividend of 31 cents works out to an amount above its latest net investment income, resulting in sub-100% coverage. Base dividend coverage remains well above 100%, but is likely to move lower as the latest Fed cut comes through the accruals. The NAV fell slightly as a result of a net realized loss, mostly offset by retained income and net unrealized appreciation. The NAV has been relatively steady over the last few years. The company has maintained a share repurchase program. Its last program expired on the 1st of March of this year, and we would look for it to be renewed as it was the previous time. During 2024, the company repurchased 658K shares, about 0.6% of the total, at a weighted average price of $9.79, equivalent to a 13% discount. This is a good use of the company's cash as it is accretive to the NAV and supports the share price. It also shows that the management is willing to forego fees on the retired assets for a shareholder-friendly purpose. Income dynamics: net new investments were up strongly after a series of flat or negative quarters. This has pushed up leverage over the quarter. The leverage target range is 0.9 to 1.25x. Portfolio asset yield has fallen over the quarter, in line with the rest of the sector. Interest expense fell as well, though not as much as new investments were funded at the higher-than-average rate via the credit facility. The company's cost of debt is a full 0.8% below the median level, giving it a strong competitive advantage. Its first ultra-low coupon maturity is in 2026. There is additional upside to net investment income as the company continues to rotate out of non-income-producing legacy assets. We would also look for it to rotate from its equity portfolio to first lien loans, further boosting income. Portfolio quality: non-accruals fell to 0.3% and remain well below the average of 1.1% in our coverage. There was another quarter of net realized losses. This is an area of the company's performance that is less than stellar and should be watched. Portfolio quality as gauged by internal ratings improved slightly. Something to keep an eye on are the CSAs or credit support agreements that BBDC holds. These were put in place on the acquisition of MVC and Sierra assets. Specifically, they partly insulate BBDC from losses on the acquired assets by manager Barings LLC, up to the maximum of the respective CSA. The MVC Capital CSA has mostly been soaked up. There are 4 issuers remaining in the portfolio, a number which has held steady over the past year, while the CSA has been written up from $17.3 million to $19.3 million. Less than $4 million remains there. On the Sierra side, the number of issuers in the legacy portfolio has decreased from 37 to 23 in the past year, while the CSA has been written up from $40.5 million to $44.2 million, with more than half of the cushion remaining. Nearly half the portfolio in dollar terms has been rotated out. The assets of the legacy portfolios have been decreasing, now making up about 7% of the overall portfolio on fair value. Given these assets have now been in the portfolio for several years, it seems unlikely they would deliver negative surprises if they haven't been written down yet. The company's relatively high hurdle rate of 8.25% for incentive fees will likely provide a competitive advantage versus the rest of the sector, particularly if the Fed surprises to the downside. As base rates come down, BBDC incentive fees should fall relative to the sector, supporting NII. Return and valuation profile. BBDC continues to perform at a slightly below average level in our coverage, though not by much. The total NAV return gap to the average BDC over the past year is about 1% and a bit higher on a median basis. On a 3-year horizon, the gap is around 0 to 1%, depending on the basis. The valuation has been fairly volatile, ranging between a 30% and flat discount over the last few years. The average historic valuation differential has been around 15%, and the stock is trading at that valuation differential today. Valuation-adjusted performance is fairly attractive, as the valuation differential has generally been wider than the performance differential. We recently added to our BBDC position when its valuation differential to the sector was a bit wider of the level as of this writing, providing a greater margin of safety. The company has been performing better in relative terms than its valuation implies. This, along with its low level of interest expense, a high incentive fee hurdle rate, and other positive features make it an appealing holding. This article was written by ADS Analytics.